In this video, we're going to talk a little bit about the top-down versus bottom-up investment analysis approach. And the top-down investment approach, flip this around, starts with an economic analysis, kind of a broad picture, and that's why it's called top-down, is because you're starting with the big outlook. Once you get done with your economic analysis, then you move down to an industry analysis, what's going on within the particular industries. And then finally, you get down to the firm analysis, what's going on within the individual company. So that's referred to as the top-down investment approach. It's one of the more common approaches that's used. CFA analysis is based on a top-down investment approach. And the idea behind the top-down investment approach is that if you look at investment returns over time, a large part of your investment returns are going to be based on macro issues. Good example of that is if you look at the financial crisis that happened in 2008, early 2009. During that time period, it didn't really matter which company you picked. Some companies did worse than others, obviously, but if you own stocks, you lost money. If you look right now, I'm filming this video in August of 2011. The U.S. just had their debt downgraded by S&P from AAA to AA+. Just got done with pretty heated battle over a debt ceiling negotiation. And during the week I'm filming this, we've just finished the first day in the Dow Jones Industrial Average where we've had 4 consecutive 400 plus point swings. Very volatile period right now, and at least during this week, it's not as much about stock selection, but instead what's happening to the overall economy. Within industries, if you think about, if you are in a good industry, an industry that's doing well, let me go back to the financial crisis. If you were in a relatively safe industry, you were still going to lose money, but not as much as if, for example, you owned banks. Anything in the financial industry got killed. Didn't matter if it was a reasonably good bank or a bad bank that was going to go under. That industry was feeling a lot of stress, so everything in the industry went down. So the idea of this top-down investment approach is that the big pictures are probably going to outweigh the little pictures. What's going on in the overall economy, what's going on in particular industries is probably going to be more important to your firm or to your investment analysis than firm analysis. This is especially true assuming that you're owning a diversified portfolio. If you're owning a diversified portfolio, you probably have 50 or more individual companies in there. So it's not realistic to say every company in your portfolio is going to be among those top performing companies, that you're always going to pick good companies, you're always going to avoid bad ones. So the bulk of your investment return is going to be driven by your industry diversification, what your weighting is in particular industries, and the overall economic outlook. Now, when we start with our top-down approach and we start with an economic analysis, what are we looking at? First thing we need to do is develop an economic outlook. What do we think is going to happen? So this gets into our economic forecasting. I mentioned that the CFA uses a top-down approach in their analysis. One of the things that is covered heavily on the CFA Level 1 exam is economic analysis. That's why they want you to be aware of some basic economic skills, and the ability to do economic analysis is because it's part of the investment analysis framework. So what kinds of things are we looking at here? Well, one is we're looking at fiscal policy. What's going on with the government's fiscal policy? And as I mentioned, right now, I'm filming this in August 2011, and that's been a huge debate that's affecting not just the U.S., but global issues all over global markets. Right now, we have situations in Europe where a lot of those countries are trying to scale back their fiscal activities dramatically. What's that going to have on impact on growth in the near term? and in the long term for those countries. In the U.S., we've got major budget issues that are being discussed. What's going to happen to government spending programs? What's going to happen to taxing? How's that going to affect the economy? So those are big issues right now that are driving the stock market, and that's one of the reasons why we see global markets, especially in Europe and also in the U.S., being so volatile right now, is because people don't have a good handle on what the fiscal outlook is going to be. There's too much unknown uncertainty there, and that's driving a lot of volatility. We also have monetary policy. In the U.S., that's largely driven by the Federal Reserve. One of the things being discussed right now, again, I'm filming this in August 2011, is what is the Federal Reserve going to do? We just finished QE2. QE2 stands for quantitative easing. It was the second round where the Federal Reserve was going out and buying a lot of bonds in order to help keep interest rates down and push money into the economy. Now, at this point, the Federal Reserve has not declared that they are going to pursue QE3. That's one of the concerns that the markets have. But they did just come out with a policy earlier this week that they promised to keep interest rates low through 2013. So that's a more relaxed monetary policy. Theoretically, that should help keep growth higher. Now, right now, growth is very slow due to concerns about fiscal policy, due to concerns about the economy as a whole. But the monetary policy factor, at least as of right now, is a positive force in the economy based on traditional economic theory. Another thing you'd be looking at is GDP growth. This is a big issue right now, is the economies for most developed countries are growing rather slowly. This is, again, Europe and the U.S. are really getting hit hard by this. Growth outlook, where is it going to come from? How are we going to get growth going, and how is that going to affect the overall markets? If GDP is growing rapidly, companies are going to have an easier time making profits. If GDP slows down, that might hurt company profitability. What's the employment picture looking like? The more people that are employed, the more people that can go out and buy things, that's probably going to be positive to companies' cash flows. On the other hand, you could make an argument that if employment starts to get too strong, we have extremely low unemployment ratios, then we might start to see a pickup in labor costs, and that could hurt the overall economy. So during periods where employment is weak, we want to see that pick up, because that's going to help the demand side get people buying more and increase sales for corporations. On the other hand, if employment is too strong, we might worry that that's going to cause an overheated labor market, higher labor costs, and that could hurt employees or hurt company bottom lines due to higher employment costs. Now, again, I'm not speaking of all this from a social economic standpoint. I'm looking at it from an investment analysis standpoint. Inflation. What's happening to inflation? The higher inflation is, now we have to look at the ability of companies to pass on those costs. Also, higher inflation can lead to higher interest rates. That's something that we have to look at. We might look at things like leading economic indicators. We might look at consumer sentiment, retail sales, productivity, all kinds of different things that try to help us get an economic outlook. Where do we see the economy going over the next 3 to 5 years? That's going to factor into our analysis. The stronger our economic outlook, the more we're probably willing to pay for stocks. I won't say this makes us want to increase our exposure to stocks automatically, because we have to look at valuation, but the better our economic outlook, the more we're going to be willing to pay for stocks. The worse our economic outlook, the less we're willing to pay. We can determine baseline required returns based partly off of interest rates, GDP growth, risk. Kind of things we're looking at here is, what is our risk-free rate? And what is the market risk premium? All else equal, the stronger our economic outlook, the lower that market risk premium is going to be. The weaker our economic outlook, the higher that market risk premium is going to have to be. We might also use our economic analysis to start thinking about our asset allocation. Do we want to scale back a little bit on equity exposure? Do we want to increase equity exposure? If we think the economy is going to increase and get stronger than maybe the market consensus, that would be the time to increase our exposure to stocks. If we think the economy is going to turn weaker than market consensus, then we want to scale back on our stocks. So we kind of want to look at what our economic outlook is, compare that to the consensus. If we think the economy is looking better, increase our exposure to stocks because they'll probably do better than anticipated. If we think the economy is looking weaker, we might want to scale that back. Economic analysis can also help us maybe identify industries that will do better or worse. For example, if we think the economy is going to be turning up, we might start to look at some of those cyclical companies, things like automotive manufacturers, heavy equipment manufacturers, industries that are going to do well under a strong economy. If we think the economy is going to turn down, we might try to look at safer places to put our money, kind of like consumer staples. Maybe if I think the economy is going to be weak, I want to put more money in a company like Kellogg's or McDonald's, things that are going to do well even if the economy is not real strong. So that economic analysis is the first step and a very important step to our top-down investment analysis approach. Then we want to look at industry analysis. With industry analysis, there's several things we're looking at. One, what is the industry life cycle? Is it in a development stage, a growth stage, a mature stage? And I'm not going to get into all the industry life cycle analysis here. This video would get way too long if I went into that. But there's a section of analysis that looks at industry life cycle based on things like sales growth, ability of companies to pay dividends, and things like that, profitability. Those things are going to determine not whether or not you want to buy an industry, but what the valuation levels you're looking at for an industry. For example, an industry in a growth stage of this industry life cycle is probably going to have higher PEs than an industry in a mature stage of the life cycle. Doesn't mean maturity is bad, doesn't mean growth is good, just means what price we're willing to pay is going to change. There's a state in the industry life cycle called decline, where sales actually start to decline across the industry. A lot of times students will see that decline and say, hey, I don't want to buy stocks that are in the decline stage of the industry life cycle, but that's not the approach you want to take. Instead, you might still want to buy stocks in the decline stage if the valuation is cheap enough. So even if sales are going down, if we can buy that company cheap enough or buy that industry cheap enough, it might be attractive. Company in the growth stage of the industry life cycle might be a bad investment even though the company is growing well because it's too expensive. So we want to be careful. Industry life cycle is not buy, sell. Instead, it's more what kind of valuation are we thinking. We also want to look at competitive structure. You might be familiar with the idea of Porter's 5 forces of competition. Looks at things like rivalry among existing competitors, barriers to entry, things like that. Essentially, the more competitive an industry is, the lower the profitability of that industry, and generally the less value we'll place on those companies. The less competitive the industry, the higher the profitability, and the more valuable the companies are typically going to be. So that's something we want to look at. Again, it's not saying we want to avoid stocks in competitive industries. It's not saying we want to buy stocks that are in less competitive industries. Instead, it's a valuation issue. Market form. This is where you get into, is the industry an oligopoly? Is it a monopoly? Is it perfect competition? Which, by the way, perfect competition almost never exists outside of textbooks. Instead, most companies see various stages of monopolistic competition. And depending on the competitive structure of the market form, you're going to have different valuation analysis again. Supply and demand conditions. For example, you might look at things like the energy industry. What is the supply issue? There are a lot of people right now that are talking about peak oil, which means that oil supply is not going to be able to keep up with demand over the future, and we're going to see a continuous rise in oil prices. That would be a supply-demand issue for oil companies that's going to affect them. Legal and regulatory risk. What is the legal environment for your industry? What is the regulatory situation for your industry? How is that going to affect profitability and valuations? Typically, the higher the regulatory structure, the more costs, the less likely you're going to be able to generate strong profits. Legal issues might help companies, might help create barriers to entry, for example, or there might be legal costs that keep profits down. So we don't know how that's going to work, but we have to look at industry by industry and try to figure out what the impacts of those legal and regulatory issues are. What are some risks of our industry? For example, I might be looking at cloud computing, and I might be looking at that as an industry, what companies are in there. One of the risks that might show up there is security. How secure can they keep the information that they're storing in the cloud? That's a big risk factor. If there are a couple of big publicized problems, that's going to hurt the entire industry. If we go a couple of years and demonstrate very strong security, that risk is going to be minimized. All else equal, the greater the risks involved, again, the lower the valuation. So a lot of what we're trying to do here with industry analysis is not make a buy or sell decision automatically, but figure out valuation issues. How fast do we expect that industry to grow? What levels of profitability do they have? Is this something we should expect the industry in general to have higher PE ratios or lower PE ratios? So that might be something that we're looking at. Lower versus higher. PE ratios. What's acceptable for that industry? Now, we might also, once we've looked at all these things and looked a little bit about the industry valuation or look at the risks that we're willing to face, think about whether we want to overweight that industry or underweight that industry. If we think that the industry outlook is better than valuation suggests, we're going to overweight it. If we think the industry outlook is worse than valuation suggests, we're going to underweight that industry. So now we've looked at the overall economic outlook, we've looked at industry, now we're ready to get down to our firm analysis. Look at the individual company. One of the things you might do here is determine the appropriate discount rate. We already looked at the risk-free rate and market risk premium early in our economic analysis. So now we're coming up with our beta, and we're going to use those in the security market line in order to determine a discount rate to use for our individual company when we're discounting cash flows. Another thing we're going to do in this stage is try to forecast our earnings and cash flows for the company. Now, this is a big challenge. Analysts spend a lot of time trying to forecast those earnings, forecast cash flows. They're trying to look at the competitive structure of the industry. They're trying to look at what products the company is introducing. They're trying to look at all kinds of different things to try to figure out what the company is going to generate in sales, what their cost structure is going to be, and what that's going to leave for earnings and cash flows. Might be checking through the supply chain, see what's happening with input costs, check with some retailers, see how well the products are moving. Anything they can do to try to get a better feel for what sales and costs are going to be is going to help them forecast earnings and cash flows. A lot of times there's going to be some pretty complex spreadsheets set up, but modeling these earnings and cash flows is a big part of an analyst's job. I'm going to be looking at risk factors. For example, if I take Apple, one of their risk factors is how well they're going to be able to continue to innovate new products, what their competition is. Apple came out with the iPad, and a lot of people, including myself, wondered if there was going to be a market for it. The market was much better than people anticipated. But as soon as that happened, competition comes in. More people try to copy. So Apple had to keep innovating, making sure they stay one step ahead of their competitors. They've got to eventually start looking beyond there. Once everybody owns an iPad or iPad 2 or iPad 3, what next area are they going to branch into? Those are risk factors. The cost structure is going to be a risk factor. Are they going to be able to keep their costs down with those things? All kinds of different risk factors, lawsuits that might come up for companies. What is their financial structure? Do they have enough debt? Do they have too much debt? How does that impact our valuation? We might do some ratio analysis. Things like return on assets, return on equity, net profit margin, asset turnover, inventory turnover, days sales outstanding, all those things. Now, one thing I want to really stress, a lot of times I see students look at ratio analysis and think that ratio analysis leads to a buy-sell decision. It doesn't. Cross that out of your head. We're not doing buy-sell analysis with ratios. Instead, we're looking at the health of the company. A good company does not automatically mean a good investment. It has to think of what we're getting versus what we're paying. An analogy I use in class a lot of time is most students are probably not driving their dream car. Not because the car they have they like better, it's a better car, but the affordability factor. When you're buying a stock, it's not just what you're getting that you have to look at, but you have to make sure what you're getting is worth more than you pay in order for it to be a good investment. If we're looking at just ratios, we tend to be focusing more on the what you're getting. We have to also look at what you're paying. Earnings quality. It's not enough just to know what earnings are, but as a company being real aggressive in their accounting in order to get there. Is a company being real conservative in their accounting? The lower the earnings quality, the less valuable those earnings are. Management and strategic issues. How good is management? This is a harder thing to gauge. It's more of a qualitative issue than a quantitative issue. Strategic issues. What new products are they developing? Are they going to work? Those kinds of things. And again, a lot of that is qualitative issues. You have to decide how comfortable you think you are with management, how comfortable you are with the strategic outlook of the company. Are they on the right track? Are they on the wrong track? Are they going to be able to execute? And those things are going to play a big part in whether or not you should buy the stock. Determining the appropriate price-earnings ratio that you're willing to pay is the way some people approach that. I'm a bigger fan of discounted cash flow analysis. Try to forecast those cash flows, figure out your return that you need, and figure out what those cash flows are worth. Now you have to be careful because if you don't do a good job of forecasting the cash flows, this is not going to give you a very good result. But the better you can do at forecasting cash flows, determining an appropriate discount rate, the more likely this is going to be your best approach to identifying good stocks to buy. Now, I've just spent quite a bit of time talking about the top-down investment approach. Like I said, that's a very popular approach used in the investment field. However, you might remember at the start of this video, I said top-down versus bottom-up. Bottom up says, let's not worry as much about the economic outlook, industry outlook. Let's instead try to find good companies and invest in those companies. Now, while I do agree with a lot of the issues in the top-down investment approach, it's hard to ignore somebody that I grew up on and got interested in finance when he was the guy in finance. Peter Lynch. Peter Lynch is an investor that ran Fidelity Magellan Mutual Fund for over a decade, and during the time he ran Fidelity Magellan Mutual Fund, he just knocked the ball out of the park. It's hard to really describe how much better he did than most mutual funds out there. He just totally destroyed on a risk-adjusted return basis. And One of the things that came from a book that Peter Lynch wrote called Beating the Street: nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you're invested. Peter Lynch was a big fan of the bottoms-up approach, finding good companies. Now, one thing you have to be careful about: a lot of people took Peter Lynch's advice and took only part of the advice. What Peter Lynch is talking about is finding a good company and making sure that the valuation fits. Don't just find a product that you like, but make sure that the company is doing well with that product. For example, you might go out and say, that SodaStream thing looks pretty neat. A SodaStream is a company that's gained a lot of traction in the last year or two for selling a homemade soda device. They had an initial public offering about a year ago, and their stock price has done really well. What you want to be careful about, though, is don't base your opinion to buy or sell the stock based on whether you like the product. That if you think it's a good product, that might open your interest in the company, but then you have to dig deeper. You have to go through the financial statements. You have to look at the profitability, the valuation. Use that as a starting point. So Peter Lynch was famous for saying, buy what you know, walk through the mall, think of products that are doing well, and look at those. But a lot of people stop there, and that's not what Peter Lynch was saying. What he was saying is use that as an idea generation process, then dig into the companies, make sure they're good. Don't buy Chipotle stock just because you enjoy eating at Chipotle, but if you enjoy eating at Chipotle, that may be a stock to look into and see if the valuation fits, if the company is doing as well as you would guess from the project, or if there's other, or from their product, or if you think there's problems that might be out there in their future. So don't just buy the product. Use that as a starting point, but make sure you really dig into the company. Going back up to the top, nobody can predict interest rates or future direction of the economy or the stock market. I think there's a lot of value to that. There's been a couple studies that look at the ability to predict economic growth or interest rate changes, and generally naive models that say growth is the same as it was last quarter or the interest rate's going to be the same as it was last quarter tend to do as well, if not better sometimes, than more complicated economic analysis. And lots of studies look at people's ability to time the stock market, and for most of us it's not very good. The average investor does worse than the average mutual fund because instead of the time-honored advice to buy low and sell high, we tend to do just the opposite. We tend to buy high and sell low. We sell when we're panicked and things are looking terrible, and then we buy when we get more comfortable after the stock market has gone back up. So we miss that bounce from the bottom to the level where we start to get comfortable with. So the Peter Lynch argument is we're not going to do a good job of the economic analysis, so instead let's just focus on the companies. Which is the approach to take? That's up to you, but this should give you some things to think about with the top-down versus bottom-up investment approaches. Thank you.